Hello, everyone. Good afternoon, and welcome to our session, Financial Economics, and the theme is Islamic Finance. It's a great pleasure to have you today, and I hope you enjoyed the conference. So today in this session, it's a great pleasure to be the chair and the discussion. I'm Ahmed Elsayed. I'm Associate Professor in Finance and Financial Economics in United Arab Emirates, and also a Research Fellow in ERF. So today in our session, we have very interesting three presentations. So the first one is about financial inclusion in reducing youth employment and mortality in the MENA region by Jabrane Amaghouss and Hanane El Masmari. The second presentation will be on financialization and income inequality by Abdullah, Gülcü, Erdal, Özmen, and Fatma Taşdemir. The last one, we have an interesting topic on MENA stock market decoupling, the winner and the loser from the war in the Middle East and Ukraine by Hakim and Simon Neaime. So just very few housekeeping. The session will last for 1.5 hours. So technically, we have 30 minutes for each presentation. The presenter will have 15 minutes presentation, followed by 10 minutes comments from discussant, and also we will have 5 minutes for Q&A from the floor and audience. So let me start by inviting our first speaker today. So Dr. Hanane El Masmari will be talking about the role of financial inclusion in reducing youth employment and mortality in MENA region. Dr. Hanane, the floor is yours.
Okay. Thank you. So, ladies and gentlemen, my name is Masmari Hanane. I'm honored to present this communication titled The Role of Financial Inclusion in Reducing Youth Unemployment and Mortality in the MENA region. As part of this conference, so this study was conducted in collaboration with my co-chair, Professor Amaghouss Jabrane, and we would express our sincere gratitude to the Economic Research Forum for this opportunity. So this study is structured as follows. First, I will introduce our study context and search problem. Then I will review the existing literature. After that, I will explain data and methodology, followed by a discussion of results. And finally, we will conclude with the implications, limits, and perspective. Okay, so despite progress in sustainable development with an average score of 59 out of 100 in 2023, young people still suffer from various problems like limited access to labor market, economic, health and education inequalities exacerbated by various factors like demographic transition, prolonged conflict, and economic disparity. However, in recent years, increasing attention has been given to financial inclusion as a strategic approach to achieving various dimensions of sustainable development goals. And in this regard, this study aimed to analyze the impact of financial inclusion on youth unemployment and mortality in the MENA region. The main objective of this study is to derive policy recommendations on the role of financial inclusion in improving youth employment and health. Financial inclusion refers to affordable access to financial services and products like insurance, credit, and savings. And we adopt the theory of vulnerable groups, suggest that financial policies should target vulnerable segments of society, particularly young people who are among the most financially excluded. And regarding the link between financial inclusion and youth employment, or the role of financial inclusion in reducing unemployment, theoretically, this relationship can be explained by Martinson's capabilities. So this approach suggested that the aim of public policies is to increase individuals' capabilities by removing deprivations of freedom, and in this context, financial services can enable young people to develop their capabilities and their possibilities to choose and act according to their aspiration. And empirically, this hypothesis, confirmed by several studies, indicated that financial inclusion can improve development, human and creation of new employment, business investment, and reducing unemployment. However, other studies indicated that financial inclusion does not always have a significant impact on employment or unemployment. For the link between financial inclusion and health, theoretically we can understand this relationship by Grossman's health demand model, which conceptualizes health as a stock of capital that deteriorates over time due to factors like diseases and aging, but can be enhanced through investments in healthcare. However, this investment is often constrained by individuals' financial resources, and in this context, empirical researches like Gleason's and Fusion and other researches indicated that formal financial system can improve living conditions and living standards. So, according to this empirical researches, countries with a strong financial sector experience lower infant and maternal mortality. And based on this literature, we formulated two hypotheses. First, financial inclusion significantly reduces youth unemployment rate. And second hypothesis, financial inclusion significantly reduces the risk of mortality among young people. For our data, this study covers 17 MENA countries over the period 2004 to 2022. The selection of countries was determined by the data availability. And for our variables, we have two dependent variables. Youth unemployment rate measured by the proportion of young people aged 15 to 84 who are unemployed. Second dependent variable is youth mortality rate measured by the probability of dying among young people aged between 15 and 84. For our exogenous variables, we have financial inclusion index calculated using a SARMA approach based on three dimensions. Access dimension is measured by the number of commercial bank branches. Usage dimension is measured by using outstanding deposits with commercial bank and outstanding loans from commercial bank, and availability dimension measured by the number of commercial bank and automated teller machine. We added three control variables: Information and Communication Technologies Development Index, ICT Index, calculated based on using three dimensions. Access dimension is measured by mobile cellular subscription and fixed telephone subscription. Usage dimension measured by the percentage of individuals using the internet, and scales dimension measured by the average score of average years of schooling, and this index or these dimensions aggregate using principal component analysis. And we have also economic graphs and inflation. For our methodology, first we apply stationarity test, followed by a causality test using a Diameter-Square-Herland test. And for estimation of models, we apply three techniques. first pulled the penal oil-less model to understand initial insight into our relationship between our variables. And next technique is fully modify oil-less to understand or explore the potential long-term relationship between our variables. And finally, we apply two-step system GMM to address potential indigeneity. This are our models for first hypothesis. We have unemployment rate is a function of financial inclusion, ICT index, economic growth, and inflation. For second hypothesis, we have youth mortality rate is a function of financial inclusion index, ICT index, economic growth, unemployment rate, and inflation. Okay, for our results, for stationary, the results of a stationary test using EMP Zaran Shin test. We conclude that all variables are integrated of one order. And for causality analysis, we conclude that unemployment rate is unidirectionally caused by financial inclusion, ICT index, and inflation. And for mortality or youth mortality rate is have two bidirectional causality and two unidirectional causality. So it has bidirectional causality with financial inclusion and unemployment rate. And mortality rate is unidirectionally caused by ICT index and economic growth. For the results of first models, the impact of financial inclusion on youth unemployment rate, we constate that the three techniques have similar outcomes. So for the impact of financial inclusion on unemployment rate, financial inclusion can reduce unemployment rate, and this effect can be explained by the fact that financial services facilitates access to credit and other form services, encouraging self-employment. Okay, and also promotes economic integration of young people, reducing unemployment. For ICT index have a negative effect, so can be has a positive effect. So technology tools can exacerbate unemployment rate among unskilled individuals, unskilled youth. For economic growth and inflation have a negative effect, but their effect is limited. For the impact of financial inclusion on youth mortality rate, also the three models give similar outcomes. So for financial inclusion and ICT index have a negative effect and can reduce youth mortality rate. For financial inclusion, so can be explained by the fact that it enhances investment in health and education, and also it can reduce, according to the literature, financial inclusion can reduce mortality rate associated with poverty. For technology index, also can reduce mortality rate, so because it can help to early detection of diseases, and also early supports and supports digital tools enable young people to access crucial health information. For unemployment rate, economic growth and inflation have a positive effect. The unemployment rate is related to economic insecurity and limited access to basic needs. Economic growth may be its positive effect can be attributed to inequality and environmental degradation, and for inflation is related to purchasing power. So raising prices may reduce purchasing power and access to healthcare. And finally, the main implications of this study is need to promote financial literacy and expanding banking and fintech services to improve financial or to encourage financial inclusion and reducing mortality and unemployment among young people. Okay, so for the limits of this study, we have 3 limits: data constant. We only use or apply this study on 17 countries in the MENA region because other countries does not does not have sufficient data. And also we did not count for potential interaction between our variables, and maybe our variables influenced by omitted, our dependent variables may be influenced by omitted variables or unobserved factors. For perspectives, so expanding data and analyzing other contexts like sub-Saharan Africa, considering interaction effect by applying moderation and mediation models, and finally, maybe conducting qualitative data to explore how cultural influences, cultural factors influences on financial access and health, and also employment opportunity for youth. And thank you for your attention.
Thank you so much, Dr. Hanane, for this very informative and interesting presentation. It's a very hot topic at the moment, looking at youth unemployment and mortality in the case of MENA region. Let me start very quickly by summarizing some of the key part of the paper. So I'm not going to spend much time on the research question and the empirical finding, which actually Dr. Hanane just already explained very clearly. So the research question of the paper, looking at the impact of financial inclusion on youth unemployment and mortality rate in MENA region. In doing so, an extensive panel of data set consists of 17 MENA countries included over the period from 2004 up to 2022. And to investigate the research question under consideration, 2 different econometric techniques have been used. The fully modified ordinary least square and the system GMM model that actually taken into account the endogeneity issue, which simply it's a very severe issue when it comes to panel data analysis. Very briefly about the key finding from the study, a more inclusive financial system can enhance youth employment and also reduce mortality rates. Also, the study find a unidirectional relationship running from financial inclusion to youth unemployment. However, there is a bidirectional relationship between financial inclusion and youth mortality rate. I have enjoyed reading the paper. It's a very interesting paper, very hot topic at the moment. And I just have very few comments and also suggestions for further improvement. So my first comment is related to the introduction of the paper. The introduction actually is very concise, able to motivate the topic under consideration, highlight the importance of this issue currently, but it actually lacks one important aspect, which simply speaking, the research gap and also the contribution. So in order to be able to motivate the topic under consideration and motivate your research question, you need actually to very briefly highlight the existing literature currently. And by highlighting the current literature, you will be able to shed more lights on the contribution of this study. And how you actually add to this existing literature. So this is very, very important to be highlighted in the introduction section, because by doing this, you will be able to sell your paper to the reader, but also for potential journal. Another issue is, simply speaking, when I looked at the methodology as well as the empirical analysis, I found that is you start talking about the direction of causality, but simply neither the title nor the introduction talking about the causality. And also when you look at the title of the paper, it's very clear looking at the impact of financial inclusion on youth unemployment and mortality rate. So looking at the direction of causality was kind of like a surprise to me later on in the middle of the paper. Also, you tried to have a very extensive analysis by combining two issues. All right, the first one is impact of financial inclusion on youth unemployment, which actually a very important issue that actually needs attention, especially under current situation. And another issue also you looked at, the impact of financial inclusion on mortality rate. But I was asking myself, so it wasn't clear in the paper why you actually merging these two issues, why you are looking at the impact of financial inclusion on two different aspects, all right? The youth unemployment as well as the mortality rate. You could have a complete two different paper by looking at each of these two aspects. And by doing so, actually, this will give you the opportunity to expand in terms of the discussion and dig deep into each of these two dimensions to make the analysis much more rigorous and more, I'll say, concise. Also, another observation through the paper, sometimes you use the term financial development and financial inclusion interchangeably. But technically speaking, these are completely two different terminology. So just make sure that is you use one terminology, and I prefer that is you stick to financial inclusion, since this is the main objective of the paper, because financial development is completely different terminology with complete different proxies as well. Another thing that is strike me in the paper, that the study used several variables as a control variable. So you used information communication technology, inflation, GDP per capita, without any justifications. Right? Why you actually focus on those three variables and you decided to include those variables in your model and empirical analysis and not any others? The choice of the variable to be included actually should be driven from the theoretical background and theoretical foundation of your topic. And this will allow you to look at actually the channel or the moderating variable for the relationship under consideration. So simply speaking, all right, there are some other variable that could be actually used that actually have a very clear justification from a theoretical point of view. And this actually take me to the last point of my comments, which is related to your empirical results. So the results from the models highlight the fact that economic growth has no impact on youth unemployment. However, it has a positive impact on mortality rate. So this observation actually is very surprising, given actually the fact that we all existing literature highlighted that is a very significant impact of economic growth and economic development on unemployment. This is a very well established results in the current literature. So having such contradicting finding just raise the point about the validity of the empirical results of your model under consideration, because it might be the fact that the model suffer from omitted variable. And this actually take me the point that is the variable to be included in the model should be actually based on theoretical foundation. And if we look at those background and theoretical foundation, you see that there are some other variables such as the financial development. So you didn't take into consideration the level of financial development, the institutional quality, also the level of education or financial literacy. All right. This is now there is a huge literature on the importance of education and financial education or financial literacy and its impact on employment as well as the mortality rate. Because if there is a financial development, it doesn't mean that is everyone will be able to have access to the financial service. And even they do have access to the financial service, that doesn't mean they will be able to get advantage of this available service, which allow them to join the labor market, or in other words, to get access to start their own business. So there is a certain level of financial literacy which allow them to take this advantage. So I stop here. I hope you find the comments very useful. But if you have any questions, definitely I will be happy to just have more discussion. So we're stopping here, and let's have a couple of questions from the floor, and then you will be able to comment after this. Okay.
Thank you very much for your presentation. It's a very interesting topic. In addition to the comments, I would like to ask a question whether for the exogenous variables, I think that there might be a relation between GDP and financial inclusion simultaneously. There might be a simultaneous relation. Did you check that there is a simultaneous relation between the exogenous variable or control variables? Because as I look some papers, there is a relation between financial inclusion and GDP.
So multicoloniality?
Multicoloniality, yeah.
Can we have a couple of questions, and then you should be able to answer all of them?
The second,
but you can answer two of them.
The second question is that you have found that there is no impact of GDP on unemployment. There might be that you use a linear model if you impose the quadratic form of GDP or a non-linear structure of a non-linear model, then there might be a relation between GDP and unemployment, because in the literature we know that there is a direct impact of GDP on unemployment. Maybe there might be the different relation between GDP and unemployment rather than linear relation. These are two questions. Thank you.
Thank you so much. We have any other comments from the floor? Okay, thank you so much. So, Dr. Hanane, if you would like to just comment on few of them, because you only have 3 minutes. Thank you.
Okay, so for your comment, we use two different dimensions, unemployment and mortality. Yes, you have right, but so the aim of this study is a general tested or analyzed the role of financial inclusion in improvement, sustainable development goals, and we have chosen these two dimensions because it's included in sustainable development goals. And for justification of control variables, we have justified using of this control variable in the paper. So we justified all control variable. And for education level, education level is include. Vous avez mentionné, pardon, je vais expliquer plus en français. Vous comprenez français? Okay.
We should speak English.
Okay. So, for education level is integrated in ICT index. So because you mentioned, I don't use education level is integrated in ICT index. For multicoloniality problem, I have tested eventual multicoloniality problem using variance VIF variance inflation factor, and we conclude does not we don't have a multicoloniality problem. So that's all. Thank you.
Thank you so much, Dr. Hanane. It's a pleasure to listen to your comments and your presentation. So now let's move on to our second presentation today, which is the financialization and the impact on income inequality from global perspective. The paper is by Abdullah Jaluk, Erdal, Özmen, and Fatma Taşdemir. Thank you so much, Dr. Abdullah. The floor is yours, and here you go.
Thank you very much. Hi everyone. I am so glad to present one of our co-authored papers with Erdal, Özmen, and Fatma Taşdemir. By the way, I am Abdullah Gülcü, and today I will invest in this study. We are investing the impact of different aspects of financialization on income inequality in this study. And why it's an important issue, when we look at recent decade, we see that there is inequality has been growing within countries in recent 2 decades, both in advanced economies and emerging market and developing economies. Why it's important? Because inequality is often associated with lower growth, higher instability, higher social costs, for example, violence and criminal activities, and deterioration in health outcomes. That's why inequality, the issue of income inequality is not only top policy issue among the policymakers, and also it's a rising hot topic among the researchers recent years. In the recent studies, recent studies suggest that innovation and technology, trade openness and globalization, level and composition of capital flows, institutional condition and governance, household debts are main determinants of the inequality. But in this study, we focus on the different aspects of financialization on income inequality. We narrow down our questions. We first look at the impact of financialization. But what is financialization? In the literature, financialization generally refers to the increasing role of the financial motives, financial actors, financial markets, and financial institutions in an economy. Here, when we refer to financialization, we look at first the international aspect of financialization and the domestic aspect of financialization. For international aspect of financialization, we use the fact of international financial integration measurement as we measured as the sum of the international assets and liabilities as a share of GDP. And for the financial development, which is domestic aspect of financialization, we use the Financial Development Index developed by the IMF. And the relation between income inequality and IFI, why it's important? Because in the recent decades, we see that a huge movement in the capital flows, both in advanced economies and emerging markets and developing economies. More specifically, we see that a huge movement from capital movement from advanced economies to EMD economies. What is the impact on it? According to conventional theory, it states that the impact of financialization on income inequality is invariant. On inequality is invariant to the level of financial globalization and financial development. But the earlier empirical studies shows the reverse of it. They state that the financial openness and integration may lead to higher growth. increasing income of the poor and decreasing income inequality, especially in developing economies. That's why it has a decreasing impact on inequality. But the recent studies shows that the reverse of it. When the financial development, while financial integration increased too much, it has a diverse effect on inequality. The state financialization is often associated with macroeconomic instability and financial crisis, both of which has adverse effect on poor and thus contribute to inequality, according to Stiglitz. But this hypothesis true generally in EMD economies. When the financialization does not controlled very well among the policymakers. And also recent studies also shows that the inequality effect of financial globalization may change depending on the direction of the financial globalization, which means that the impact of the capital inflows may be different than the impact of the capital outflows on inequality. And according to Lee et al. Theoretical models, it provides that the capital inflow surges disproportionately increase entrepreneurs' income and thus violate the income inequality, violate the even distribution of the income. And also inequality impact of financial globalization may be conditional on the domestic factors for domestic financial sectors. So here in this tree graph, we shows the historical stage of the international financial integration. According to in our time period, we see that international financial integration has increased both in advanced economies and EMD economies. But in advanced economies, while capital inflows and outflows are very close to each other, in EMD economies, we see that there is a huge capital inflows from advanced economies and to EMD economies. So the impact might be different in these two country groups. And in these two graphs, in the left-hand side graph, we shows the evolution of income inequality in advanced economies and EMD economies. Accordingly, we see that until 2000, there is the income inequality between advanced economies and EMD economies very close to each other. But after 2000, we said there is a divergence between these two groups. It might be due to that for the income inequality we use, I will explain later, we use the Gini index for the income inequality, but Gini index for pre-tax income. That's why we see the divergence between these two groups. And the right-hand side, we have a scatter plot showing the relation between IFI and income inequality. Accordingly, we see that there is no linear relation between these two variables, which means that the impact of inequality depends on the level of IFI. We also, in this study, we also look at the impact of financial development on inequality. Accordingly, we try to understand what would be the impact of international financial integration under the different level of financial development, under the different level of domestic financial improvement. But in financial development index, it is important to talk about the intensive and extensive margin. According to intensive extensive margin hypothesis of financial development, it states that the extensive margin implies the broader use of the financial service by individuals, so it has a decreasing impact on inequality. But according to the intensive margin hypothesis, the improvement in the equality of financial services will benefit to the already existing entrepreneurs in the system, so it will widen the distribution of the inequality. So we see that there is a different effect of financial development on income inequality. So we try to answer which hypothesis dominates in different country groups. And let me skip here. And then we also look at the impact of growth and inequality. We use growth as a control variable. Because why we use growth as a control variable? Because of the rising tide hypothesis. This hypothesis states that rising tide lifts all boats, which means that growth enhancement will benefit to the whole segment of the population and will decrease the income inequality. But the recent studies shows that the reverse of this hypothesis, analysis, it benefits to the highest segments of the population, and then it will increase the income inequality. So we would look at impact of growth on inequality in order to see whether this hypothesis holds or not. And what is our contribution in the existing literature, or general look at the impact of the financialization on inequality by using the linear models or by some quadratic form by considering the threshold to be exogenously determined. But in our contribution to the existing literature is that we use and apply the panel effect threshold methodology proposed by Hansen in order to impact analysis, in order to examine the nonlinear impact of financialization on income inequality. And by doing this, we use two folds. First, looking at the international financial integration and the domestic side of the financialization. And also for the international side of the financialization, we decompose IFI into two parts, as an asset part and the liability part, in order to see which, in order to see the main driving force of the relation. And we also doing analysis by for advanced economics and EMD economies separately and as a whole. Here is the benchmark model. In the left-hand side, we have Gini coefficient pre-tax income as a proxy for the inequality. And the right-hand side, we have a control variable of the lagged value of real GDP per capita. We use the lagged value of real GDP per capita in order to eliminate the possible endogeneity problem. And also we, in line with the literature, we also include human capital and governance indicators. For human capital indicator, we use the human capital index proxied by years of schooling and returns to education. It's a very commonly used indicator for human capital. And for governance indicator, we know that in some studies shows that IFI has a negative impact on inequality under the good institutional qualities. That's why we use governance as a control variable. For governance, we use the standardized value of the average of 6 main components, which are voice and accountability, rule of law, political stability and no violence, government effectiveness, control of corruption, and regulatory qualities. We use this, we measure governance as these three, average of these 6 components, because due to some of the researchers doing the same thing, Kaufman, for example, Kaufman et al., Köse et al., doing same measurement. That's why we calculate governance indicators. And for financialization, as I said, we use both de facto financial openness and domestic financial development variables. Yeah. Here our first model, in this first model, we only impose international financial integration to be regime dependent. Other control variables are regime independent, implying that actually we also impose other variables to be regime dependent, but the result was not significant. That's why we prefer to use this model. Lambda shows us the data-derived estimated threshold. And if lambda is, if IFI is less than lambda value, it implies that we are in the less integrated financial integration periods. And if IFI greater than lambda, which is alpha 5, shows the more integrated periods. And according to Yu and Phillips, both the threshold point and the threshold effect parameters are identified without the need of instrumentation. That's why our estimation may be interpreted as well even under the endogeneity of the threshold variables. Our sampling consists of 24 endogenous advanced economies and 52 EMD economies for the period of 1996 to 2019. Since our model is balanced data, we prefer to use these time periods. Here are the first results when we use IFI as a threshold. According to our results, IFI provides a data-driven threshold level both in advanced economies and EMD economies significantly. And when we look at the IFI coefficient, we see that for advanced economies, the impact of IFI on inequality is positive, but increasing positive impact of IFI on inequality is decreasing in more integrated periods in advanced economies, but in EMD economies, more while in the low regime, when the IFI is below the endogenous determined threshold level, the impact on inequality is negative, but when under the high regime, we see that the impact on it positive. We see that there is a different story between advanced economies and EMD economies, and in the high regime and low regimes. In order to see the main driving mechanism of this relation, we decompose IFI into capital inflows and capital outflows. Now, this is our result when we separate IFI into capital inflows and outflows. The first three columns shows when we use asset as a threshold value, and the last three columns shows the result when we use capital inflows as a threshold values. According to this result, we see that while in advanced economies, the impact of IFI comes from in both advanced economies and both in assets and liabilities. In EMD economies, only liabilities are the driving force of the IFI and income inequality relation. And finally, we also impose financial development to be a threshold value. This model shows us that what would happen to the relation between IFI and inequality under the low level of FDI and high level of financial development. Accordingly, we see that when we use financial development as a threshold in advanced economies, we haven't found any significant threshold value. It is expected because financial development level in advanced economies is quite high. It's already quite high. That's why there is no significant relation. But in EMD economies, the impact of IFI on inequality is decreasing under the highly financially developed episodes. So, in financial, we see, this result shows us that financial developments in EMD economies is still needs to be improved, needs to be increased because the financial development level is still too much in EMD economies. So, increasing financial development will decrease the increasing effect of the IFI on income inequality. Here our concluding notes, we see that the impact of IFI is different in advanced economies and EMD economies. Also, the driving force of the IFI on inequality is different in advanced economies and EMD economies, because in advanced economies, both capital outflows and inflows are the main driving force of the relation. In EMD economies, only the inflows are the driving force of the relation. And also we show that the financial developments are a significant threshold only for the EMD economies, but it's insignificant in advanced economies. It is due to that in advanced economies, it is financial development level is too high. That's why this result is expected. For the future work, we would like to analyze the subcomponent of financial integration. That is, we would like to analyze the effect of FTI and portfolio separately, because the story behind FTI and portfolio are different from each other. That's why the impact on inequality might be different. And also we would like to see the country-specific analysis, do some country-specific analysis, because each country has different story and different relation between IFI and inequality. So looking at the country-specific analysis would give us a different story and interesting story, we guess. So this is the end of my presentation. Thank you.
Thank you so much, Dr. Abdullah, for the very wealthy and extensive analysis. It's a very interesting presentation and very interesting topic. Again, I just starting by very briefly summarizing the key points from the paper, and then moving on to some suggestions for improvement. So the question, research question under investigation is looking at the nonlinear relationship between financial integration and the income inequality from a global perspective, taking into account both advanced economy as well as emerging market as well. So in doing so, the paper included 24 advanced countries, 52 emerging markets and developing economies over the period from 1996 up to 2019. And the paper used a panel fixed effect threshold model developed by Hansen in 1999 and collected an extensive data set from different sources, including the World Bank, the IFS, the World Governance Indicators, and also the external wealth of nation databases. The key finding from the paper highlighted first, there is a relationship between international financial integration and the inequality that depend on the level of international financial integration, and also that the effect of integration on inequality is driven by the joint impact of capital inflows and outflow in advanced economy. However, only capital inflow has a more pronounced impact on financial inequality in emerging and developing economies. So just to highlight some comments and future improvements. So my first comment is related to the introduction section, because when I read the introduction section, you started by highlighting the main research question and then move on to the theoretical background of this relationship to motivate research question and also existing literature, and back again to the research question. So I would suggest that is actually you just restructure the introduction section to make it more nicely flow, and the reader will be able to flow your argument very nicely. So technically starting by highlighting the key motivation of your research question, the importance, and this will be followed by highlighting a brief literature review of the existing studies to highlight the contribution, and then this will be followed by a brief discussion on the empirical finding of your model. So just make the flow of the introduction section much more straightforward and nicely connected to each other. Also, I also find that is you use the term financial globalization and financial integration interchangeably. But again, those are two different terminology. Yeah. So it would be much better to stick to one terminology throughout the whole paper. But also, and more importantly, because there are several definitions of financial integration currently in the literature. So it would be much better to provide a clear definition of financial integration, so the reader will actually know exactly or what is meant by financial integration in the context of your paper. Also, I found the figure 1 is very interesting and actually can tell more about the research question under investigation, right? So I found this figure 1 is a key fact that can motivate your research question under consideration. So by including this graph, it actually tell a very important divergence between the developing country and in developed or less developed country in terms of inequality. So based on this graph, you can start highlighting the research question and why this research question is quite important under the current scenario and a divergence between advanced and developing countries. Also, the paper could actually benefit from a methodology section. I know that you briefly highlighted that the model under consideration will be using the fixed model threshold by Hansen, but there is no detailed discussion in terms of the methodology and why this methodology is appropriate to answer the research question under consideration. There are many other econometric model and approach that could be used. So why the author decided to use this specific model of fixed threshold panel? All right. So what is the advantage of this in the context of the paper and the research question? Another issue also that might be a problematic is indigeneity problem. All right. So it might be better if you can do some robustness test using some other econometric techniques that take into consideration the issue of indigeneity using the two-stage least square or fully modified OLS estimators. This actually takes me to my next point because the empirical results and the model, I here provide just one example of your model. And I believe what I'm saying here will apply to other models as well, because you will see that you only include 4 factors. So human capital, financial development, institutional quality or governance, and also the international financial integration threshold variable. But when I read the second paragraph in your introduction, I have this quote from the second paragraph in the introduction itself, highlighting what actually the key factor that actually affecting inequality. And from here, you only choose those 4 factors, but you ignored the trade openness factor, you ignored innovation and technology, education level, for example, right? All these factors has been omitted from your analysis and omitted from your model. So this also raises concern about the stability of the estimated empirical model. So either you can provide justification why you focus your analysis on these three factors, ignoring the rest, and what would be the impact of those omitted factors. Maybe also, as I mentioned, just in a robustness test section, that you can run those models and see whether actually the results will be consistent and actually robust against those omission of those variables. So that's it from my side. But otherwise, I really did enjoy reading the paper. It has a very severe and lots of analysis. It's been very interesting. Thank you so much. And we can open the floor for questions. Okay, so now the floor is yours once again. If you would like to have, let's say, a few minutes, if you want to answer some of the questions or comment on my comments.
Thank you for your valuable comments and suggestions. This is very important for us we will consider them as well. I would like to start with explain this graph. In this graph, actually, I said in the presentation, but we didn't explain the paper. We use Gini coefficient pretext income level Gini coefficient. That's why the results are so, but we improve the paper and we also look at the impact of the Gini coefficient by using after tax and subsidies. And when we use Gini index after tax and subsidies, the relation between IFI and income inequality is different. That's why now we are analyzing it, but we will explain in the paper as well. Thank you for that suggestion. And for the methodology, you are right. There is a lack of, there's no enough explanation for why we use this information rather than using a quadratic form. Actually, we have to explain it because we didn't prefer to use a quadratic form because quadratic form shows that there might be only the inverted U shape or U shape. But in our analysis, we see that there is an inflection point, not an inverted U shape in some cases, especially in advanced economies. We see that the increasing impact of international financial integration on inequality is decreasing in the high region, but the coefficient is not negative, but it is still positive, but increasing impact of it decreasing, which means that the rate of the positive impact is decreasing. That's why there is no inverted U shape, but rather there is an inflection point there. That's why one of the reasons why we didn't use quadratic form. But you are right. For the robustness checks, we will include the quadratic form by using the OLS second two-stage OLS methodology. And for trade openness and technology, actually there are different topics and very good questions when we include technology. But in this case, we have to also consider trade openness and technology as a threshold variables as well. So doing it, it will be two different aspects. But for the rest, for the future research, we will also look at the impact of technology at trade openness, and by looking at the non-linear way of the impact of these two variables. Thank you very much.
Thank you so much, Abdullah. It's an interesting discussion, and thank you so much for sharing your knowledge on financial integration and inequality. We wish you all the best with your paper. And now we are moving on to our final paper today. It's again, we are still on financial integration and financial connectedness. So the third paper is talking about MENA stock market decoupling, winner and losers from the war in Ukraine and the Middle East, by Hakim and Simon Neaime. Thank you so much, Sam and Simon, for this wonderful presentation. It's very interesting, very informative, and also for giving me the opportunity to read and comment on your paper. Just very quickly to summarize the paper, it's mainly investigating the impact of the recent Russian-Ukraine war and also the Palestinian conflicts on integration of equity markets in the MENA region, and testing the decoupling hypothesis in MENA, in the context of MENA countries. So in doing so, the author used monthly closing indices for large and mid-cap markets in the MENA country, but also they include some advanced emerging economies such as Brazil, India, Korea, and China, as well as advanced economy, which are mainly the source of normal shocks such as the US, UK, Germany, and France. The data for the stock market were collected from the Morgan Stanley over the period from 2014 up to October 2024. And the method of analysis is Garsh vector autoregressive model. The key outcome of the paper, the author noted that these countries in the MENA regions are rejecting to take one side of the war and try to neutralize their policy, becoming more independent and take the advantage of diversifying their economy, strengthening their position, and immune their countries against external shocks. But also looking at the IMF statistics, they reached the conclusion that Egypt, Jordan are the net losers of the war, while Morocco, Algeria, and the United Arab Emirates, Turkey, are negatively affected and severely harmed by this war. So this was the main takeaway of the paper, and just allow me to highlight some comments on the structure and also some suggestions for further development. So when I read the paper, I just get quite confused what actually the main objective of the paper, because at the first half of the paper, it's mainly looking at the winners and losers of the Ukraine and political conflict between Palestine and Israel, and who are the country that actually gain or lose from those wars in terms of economic conditions, and looking at the impact of these wars and political instability in macroeconomic variables such as the bilateral trade and also central bank reserves, and how this can impact the economic conditions, generally speaking. But the second half of the paper more focus on financial connectedness and financial integration between stock markets or equity market within the region, and how actually this war impacting volatility shocks or volatility spillover across the financial markets. So it would be very, very nice actually to just at the beginning or the introduction highlight what is actually the key objective of our paper, because these two halves seems to be quite disconnected from each others. Also, the introduction section is very concise, motivate the topic under consideration, but it actually need to be strengthened further, because simply speaking, there is no any discussion about the current or the existing literature review and how this new paper actually add to the existing knowledge or add to the current literature of decoupling and financial integration. Another point is actually looking at taking your analysis one step further, and here this will be related to our first point of the objective of the paper. Is it the main objective of the paper is actually looking at the winner and the losers of the war in terms of economic conditions, or actually it's the impact of the war on financial financial integration at equity market and financial connectedness or financial shocks. If the main idea of the paper is to look at the impact of the war on economic conditions and also decoupling or financial decoupling, it would be nice also to look at the role of financial globalization, regional integration, and also technological advances on this relationship, and how it can impact the relationship under consideration. Also, if the main objective of the paper is to look at the financial integration and volatility shock transmission between equity markets across the region, it would be much better to, rather than looking at or using the static Garch vector autoregressive model that actually doesn't give much information about the dynamic and the evolvement of the correlation between the market through the the time of the war or through the sample period. So an alternative technique would be much better, such as maybe the asymmetric dynamic conditional correlation Gülcü model that allow you to depict the evolution and the dynamic of the correlation between those markets over the sample period. So it's to give you a more holistic view rather than the very static numbers that you will be able to get from the Gülcü model. Another also approach that is actually very widely known in the academia or in the literature over the last few years is simply speaking by looking at the volatility transmission and financial connectedness using one of the financial spillover techniques that has already been started or developed by Diebold and Yilmaz, and there are a very extensive family of those techniques are quite available and established in the literature at the moment. Rather than just using dummy variable to account for the war, you estimate the Gülcü model, and to account for the war, you just include a dummy variable to account for this shock. So as an alternative approach, as we mentioned, that is allow you to look at the static, to allow you to look at the dynamic rather than the static environment is by either the ADDC Gülcü model or the financial connectedness approach. Also, one possible consideration also that you might also use the geopolitical risk index that is very widely used in academia, and this index is developed by Caldaro and Echeverri, and this index that can track the political instability and war at a regional as well as global level, which actually a much more proxy for the political instability due to the war. And finally speaking, simply it's the last part in the paper was mainly about the discussion and the conclusion together, wrapped up in just one section. So I believe that is the paper will benefit. I understand this is the first version of the paper, so it's still developing. So having a separate section in terms of conclusion that can summarize the key takeaway of the paper, the policy implication, because this is actually the most important part, that is, what is the policy implication from your analysis, and what would be the future direction for policymakers. So I believe that those comments are might be very useful in terms of developing the paper and also strengthening the analysis and the discussion. But we would like to thank you so much for the wonderful presentation and also the paper. I believe our session will come to an end, but before we end our session, if there is any comments for the third paper from our audience. Okay, thank you so much. It's been a pleasure to have you. Thank you so much for our wonderful presenters. Thank you so much, and enjoy the conference.